My name's Ethan Braid. Today we're going to talk about how to invest your retirement portfolio in a recession. We're going to take a look at stock investment ideas that have worked in past recessions, what to avoid, what did not work, and we're also going to take a look at the bond market. What happened recently, the big drawdown from 2022, how to recover from that, and what might work going forward for the bond market. If you're retired or planning to retire in the next few years, this chart will be very important to you. This chart is the stock market price appreciation for the last 100 years. And what becomes very clear right away is that there have been 6 distinct major market cycles in the last century. 3 periods of bust followed by 3 periods of boom. The periods of bust, which are in red, are bear markets. They average 17 years in length. What you can see is that if you had bought in the late 1920s, you didn't break even for 25 years. 25 years is a long time to not make any money. The same thing happened again in the late 1960s until the early 80s, and again in the year 2000 to 2013. The green arrows are bull markets. Bull markets average about 11 years in length, and we can see there have been 3 major bull markets in the last century. The real question is, where are we at today in 2024? We've been in a great bull market for a number of years, 14 years since the bottom in 2009. And are we entering a bear market, or are we in a bear market now? And the question becomes, how are you going to make money on your retirement portfolio if we're in a bear market where the stock market just goes sideways for 15 or 20 years? How are you going to get income off your portfolio? How are you going to not lose your money? I'm going to show you some ways to do that. I'm going to give you some ideas on how to produce income in your portfolio, your retirement portfolio, if we're in a bear market, and how are you going to have a way to succeed with your retirement income strategy if we're in a bear market. I'm going to show you what's worked in the past, and I'm going to show you what doesn't work. If you lost a lot of money in 2022 as a result of the bond meltdown, I'm going to give you some ideas on how you can reconstruct your portfolio to fix some of those problems. Because I think there are a lot of people out there who were caught off guard in 2022. They didn't understand duration. Many financial advisors don't understand fixed income even, as sad as that is. So it's a very important concept. I'm going to show you some things that can work in the future to help rebuild your retirement plan. So stay with me. To give us some perspective on what a bear market's really like, here's the 2000 to 2013 bear market up close. 13 years, no appreciation with some huge drops along the way. So if you're retired and your portfolio is not properly structured to handle something like this, you can throw your Monte Carlo simulation financial plan forecast in the trash. It's worthless. It doesn't matter what your financial planning software says. If you could have a 60-40 asset allocation, but if your equity sleeve is heavy on the NASDAQ or heavy on growth and things that don't hold up in recessions, your financial plan is no good. I hope that as we go through this video, you can see the importance of having your investment strategy structured for the times that we're in, for where we're at in the market cycle, and also lined up with your spending needs on the portfolio. I'm going to show you some ideas and some ways to construct a retirement portfolio the proper way to survive a bear market when we get one in the future. It's not if, it's when. The only thing we don't know is how far away it is. I think we're in a very dangerous place because most investors are just trend extrapolators. And for that matter, a lot of financial advisors are too. So we've been 14 years of an incredible bull market. And think about what I said a little bit ago. We're right now getting back to the highs of 2021. If you look at the pattern that's developing in the last couple of years, we might already be in a bear market. Here is an illustration of what worked and what didn't work in the last major bear market, the period 2000 to 2013. I've graphed out a $10,000 investment in the year 2000 for 3 very popular ETFs to demonstrate how different styles of stock investment will hold up or fail during a bear market. The 3 ETFs are the Russell 1000 Value ETF, the Russell 1000 Growth ETF, and the NASDAQ 100 QQQ ETF. In all cases, we have dividends reinvested. The purple line is the Russell 1000 Value ETF. And you can see that despite the fact that we had not one but 2 recessions during this bear market, the Russell 1000 Value ETF nearly doubled in value with dividends reinvested over this 13-year period. Compare that to growth stocks. The Russell 1000 Growth Index, which is the orange line, if we started with 10,000 in the year 2000, by 2013, we're back at 10, with a lot of volatility along the way. And this is with dividends reinvested. And the NASDAQ 100 QQQ, wow, rough ride. Look at the huge drop. And then we finished 13 years later at roughly 17% below where we started. A very difficult 13-year period. Now, if you're retired and you're running a balanced portfolio, you're 60-40 or 50-50, and you have a large component of your equity exposure in growth, you've got a problem, right? Think about this for a minute. You need your retirement portfolio to pay you income. How are you getting income off the portfolio when there's minimal to no dividends and on the growth component, and it's just going down and down and down in value? Because there can be such a disparity in returns from different styles of equity investments in a bear market, this is why I say you need to be skeptical of your financial plan, the forecasting methodology, and really make sure that you have an investment strategy that can hold up in a bear market. Many people do not, and they don't realize it. If you think back to what I just said about this 14-year bull market, and people are trend extrapolators, okay? Here we've been on this great bull market, and tech stocks and growth have been on fire for many years now. Well, that was exactly the situation leading up to this point in time, 2000. And I can't tell you how many dozens of people that I personally met around 2002 to 2004 who were completely devastated. They had beautiful retirement plans. I've seen so many pie charts with great forecasts and projections, and in some cases they had nice balanced portfolios, but they were balanced the wrong way. And so you can have a 60-40 or a 70-30 or something like that, 50-50, but if you're heavy on the wrong types of equities and you hit the skids on a bear market, your retirement gets turned upside down. And many financial planners, unfortunately, don't know that, especially those who are not that well versed in investments. You might be a whiz with financial planning software and modeling tools and pie charts, but if you don't really understand investments, that's where your financial plan blows up. So I want to make you aware of that. If you're retired or looking to retire, really, really important. Now is the time to scrutinize your portfolio. Make sure that your strategy's lined up right. You want to have more dividend-paying indexes, stocks, ETFs, mutual funds in your portfolio for the equity component than growth. Really critical concept to think about. Here's another look at what worked in the last recession and what didn't in the 2000-2013 time period. S&P 500 purple line, sideways for 13 years. No return on appreciation. But here's the S&P 500 dividend. Now what I've modeled here is a $10,000 investment in the S&P 500. You can see that it gets nowhere on price. But if you had a $10,000 dividend stream, that dividend stream off the S&P 500 did grow, and it nearly doubled over this time period. Again, something important to think about. If you're retired or looking to retire, you need income from your investment portfolio. And you want to have stock indexes, individual stocks, mutual funds, whatever you're using, you want it to be in more dividend-paying stocks. That's important for a number of reasons. Dividend-paying stocks tend to be more stable. They tend to have better balance sheets. They tend to be more profitable. They tend to sell at lower PE ratio. So they'll hold up better, generally speaking, as we enter a bear market or a recession. Companies that are, say, in the NASDAQ 100 that are sky-high PE ratio, very, very low in terms of profit, high in terms of price, they're focused on growth, and they don't pay a dividend oftentimes. Those companies will crash in a stock market decline. The prices will come down precipitously. So if you have a decent amount of exposure in your retirement portfolio to growth-type companies, and we enter a bear market, you may have irrecoverable losses. Why would you do that? So don't do that. Start thinking about how to align your portfolio going forward in investments that can hold up and possibly prosper during a bear market. I remember what it was like in the late 1990s when people made fun of Warren Buffett and Charlie Munger and Jeremy Grantham and people like that. They made fun of them because they were basically talking about what I'm talking about now. Who got the last laugh? Don't be like the people that got killed in the early 2000s because they had too much of their portfolio in growth and not enough of their portfolio in boring dividend type stocks. Now let's take a look at a couple ETFs that I think make sense in this environment for a retiree or a retirement portfolio. The first one is the S&P 500 High Dividend ETF, and what we see here is a great dividend yield. This is an ETF, has 80 individual stocks in it, a lot of big names, a lot of names that you would recognize, but it pays a 4.67% yield, a great dividend yield. It's going to have volatility. Yes, you can lose money, but if you're retired, you need income, right? Here's a way to get it. And if we enter a long-term bear market, I think that this investment is going to do a lot better than, say, QQQ or IWF or something like that. Let's take a look at some of the fundamentals. Again, 4.67% yield right now. Look at our weighted average price to earnings ratio. It's only 15 times. And we're also looking at a price to book that's 1.67 times. These are realistic multiples, in my opinion, with an excellent dividend yield, some protection if we enter a bear market. Again, we enter a bear market, this thing's going to go down with everything else, but at least you're getting paid, okay? You're getting an income stream, and you won't be getting that with your average tech index or tech portfolio or growth portfolio. Here is another ETF that I think makes a lot of sense for a retirement portfolio in the current environment. We're looking at the iShares International Emerging Markets ETF, the IEMG, 3.01% dividend yield, excellent. Look at the fundamentals. We're only 13 times earnings, 1.6 times price to book value. These are great numbers in my opinion. And by the way, you can't give this stuff away. Nobody wants the emerging markets, and that's why you should be excited about it. I think this presents an excellent return opportunity going forward. It doesn't mean you can't lose money. You certainly can, but the numbers are very compelling. The S&P 500 trades at 24 times earnings, over 4 times price to book value, and about a 1.3% dividend yield. So this ETF, this index, you're buying it at less than half the price of the S&P 500 on a book value basis for more than double the yield. It's really a great opportunity, in my opinion. Again, this needs to be taken in context of your ability to withstand volatility, because you can definitely lose money here. But I do believe that if we look forward for the next 10 years, this ETF is likely to outperform the S&P 500 by a couple hundred basis points over the next decade. Great opportunity. Now let's talk about the bond market. Bonds are a very important part of any retirement strategy. And even though the bond market is the most widely used asset class, I believe that bonds are also the most highly misunderstood asset class. What we're looking at here is the Vanguard Total Bond Market ETF, BND, and I've graphed this against the 10-year U.S. Treasury. A few years ago, things got really weird and the 10-year treasury yield went under 1%. That should have been a wake-up call to a lot of people. Hey, this is just not right. We really ought to look to reorganize our retirement portfolio. We ought to be changing how our bonds are invested. Maybe we should take some profits. Maybe we should be putting money on the short end of the curve. Let's go conservative, even if we have to sacrifice yield. That's what we did for our clients. Okay, let's get away from the long-term, high-duration fixed income because it's just too dangerous. And I didn't have a crystal ball, but common sense told me we need to get away from anything that's long-term when interest rates are this low. So much risk. Unfortunately, people learn painful lessons in the last few years, as you can see this nasty drop in BND while interest rates have gone up. Bond prices have an inverse relationship to interest rates. When interest rates go down, bond prices go up and vice versa. We can also look at the TLT. This is the iShares 20-year Treasury bond ETF TLT. Really significant drop here. It's going to take many, many, many years for people to recover these losses. So I'm going to show you here in a few slides some ideas about how you can reconstruct or reorganize your bond component of your portfolio so that you can hopefully make some of your losses back. This slide we're looking at here shows what would have happened if you had $10,000 in either of these ETFs a few years ago and were retired and, say, spent the income. If you had invested $10,000 in BND or TLT a couple years ago in July, August of 2020, your $10,000 today would be about $8,000 in BND or $5,500 in TLT. I've compared this against a short duration conservative bond fund, the Fidelity Conservative Income Fund. You can see that there was a minimal loss on the Fidelity Fund. And again, this chart assumes that we invested back in, say, July, August 2020, or had whatever amount of our money already invested in July, August 2020, and we're retired and we're spending our income off the portfolio, our dividends off the bond funds, and what do we have left? You can see significant losses. At the current interest rates or yields on TLT and BND, it's going to take about 16 years in the case of TLT, maybe longer, to recoup these losses. The problem that you have if you're retired is that not only have you had a huge loss to your principal, but you need income, right? And so you don't want to start dipping into your principal, you need income. Again, this is the kind of stuff that financial planning software and fancy projections and pie charts don't really do a good job of getting their arms around, in my opinion. At some point, common sense needs to be deployed. Like I said a few years ago, common sense would have said, geez, the 10-year treasury is under 1%. This is crazy stuff. I don't think I need to have my money in, say, 10 to 30-year treasuries. That's way too dangerous. Now let's talk about what not to own and what to own in bonds in your retirement portfolio. The first thing that I would not own is the BND. Notice that the yield on BND is only 3.11%. The duration is over 6. So for every 1% movement in interest rates, you're going to make or lose 6% on price. There just isn't enough yield here, in my opinion, to justify the risk, not in this environment. If you own TLT, as unfortunately many people do, I would get rid of that too. Get it out of your portfolio. There just isn't enough yield at 3.5%, in my opinion, to justify the risk. You've got a duration of over 17. If interest rates go up by 1%, you're going to come down close to 20% on price. A lot of risk, not much reward. Also, if you're retired and you're using your portfolio for income, this is a really bad situation. You're only getting 3.5%. Your opportunity for growth is pretty limited. The only way that you'll get quote unquote growth in this investment is if interest rates go back down and go back down meaningfully. Then the price can go back up, but that's probably unlikely to happen. And do you want to make that gamble in your retirement? Probably not. I would get rid of this investment if it's in your portfolio. Now let's take a look at ideas that make sense for retirees in the bond portion of their portfolio. The first idea that I think makes a lot of sense is Fidelity Conservative Bond. Very low risk bond fund. Great yield in the current environment, 5.42%. Low risk with respect to your principal. If interest rates go up, you may have a small loss, but you're not going to have any kind of loss like we saw with BND or TLT a few years ago. The next investment that I think makes a lot of sense in this environment, and has for a long time, by the way, are floating rate loans. Fidelity has a great floating rate loan fund. Many other companies do too, by the way. I'm not advocating that you use these funds. I'm just using them as examples of things that you can consider portions of the bond market that you might want to have in your portfolio. Okay, this isn't a solicitation for these funds, know that. But Fidelity floating rate loan fund, 9% distribution yield. Again, there's risk here. If we get a recession, this fund is going to go down. Spreads will widen and loans will come down for a period of time. It may take a couple years for the prices to recover, and they might not. But one of the nice things about loans is that they're senior in the credit stack. So when you have loans, they're ahead of bonds in terms of credit for companies that borrow money. I personally am a big fan of loans, and in this environment, a 9% yield, it's a great place to be. Your interest is going to move up and down, but I'd rather be here than in TLT, me personally. Another idea that we can take a look at are mortgages. Mortgages make a lot of sense right now. Now, I do believe that the U.S. real estate market is bloated and in trouble, so it is something to consider. There's a good chance, in my estimation, that residential real estate could come down 30% in value. Not sure yet how that's going to affect the mortgage market, but I do believe that a lot of the bonds in this PIMCO portfolio are going to be eventually paid back, even if we get a major downturn in residential real estate. And this fund yields 6.7%. So look at the three ideas I've just given you. In all cases, we're getting a much greater yield over TLT or BND. So again, think of what I said. How are you going to reconstruct? How are you going to rebuild your portfolio if you had a lot of losses in the last few years? You're not going to make your money back earning 3% in BND or 3.5% in TLT. It's just not going to work. You want to get paid, and if you're retired, you need income. So look at these three ideas I've given you. In all cases, we're getting a much better yield over TLT or BND. Yes, there is risk with these ideas, and you should meet with your financial advisor and talk about these types of ideas and how to weight them in your portfolio. What risk level is appropriate for you? But at the end of the day, if you're retired, you need income in your portfolio, and you're just not getting that income from BND or TLT, even at these rates. And your principal has taken a severe loss in recent years. So these are ideas that can at least give you a lot more income as we go forward. I hope this video was helpful. I hope this video gets you thinking, helps you better analyze your investments, and improve your family's financial plan.